Hi, everyone. Welcome back again. My name is Blair Tushaus here at Tushaus Wealth Management. We're here in Scottsdale, Arizona, and also in Point Loma, San Diego, California. So today is Friday, April 17th. A lot is happening, so we're going to dive right into it. We're going to do a quick market economic recap, plus some reminders, and then we're going to wrap it up and we're going to have a great weekend. Um, What about this market run? I've posted 2 weeks ago about defined investment solutions. And right now, please take the time to go watch that video because I am talking about the people at that bottom of the market. What do they do when the market starts going down? Well, if you're fully exposed into the market, do you ride that roller coaster? And if you're not, when do you know the bottom's in or not? Nobody has that crystal ball to tell you what the next one day or 1 year or once decade's going to be like. Hence why we use those defined outcome investments. In fact, I had a client the other day. My name's Blair, and sometimes we refer to those investments as buffers because they buff out losses. And they said, "Hey, you should call yourself Buffer Blair." So who knows if that catches on? But for now, maybe people will start calling me Buffer Blair because of what those buffers are able to do to clients is take out that crystal ball, take out the uncertainty, take out that trying to time the market, not just in, but also out or out, but in. We can relax knowing that we have investments that are able to either buffer out losses if the market continues to go down, or if it does go up, we participate in that upside. So, once again, take that time 2 weeks ago, go back to Define Investment Solutions YouTube video. I think it's about 17 minutes long, but it's going to change your next 10, 20, 30 years and your outlook on retirement and the market. We had somebody who came to us not too recently with a great size portfolio, millions of dollars that they need to last for the next 30 years. And she was concerned because she had budgeting issues. She was going to run through that money like crazies. And really, there was no fat to be trimmed. And basically, she couldn't afford to be too safe and have her money not make enough. And she also could not afford to be too risky. And if she's too risky and we have a dot-com bubble of 3 years of no growth or huge pullbacks while she's eating hundreds of thousands of dollars every year into that portfolio, that's bad news. And that's why those buffers, again, are able to protect her from losses, but keep her in the market, especially while we just had a record, was it 12, 13 days now that the market has consistently had a green day. Of course, here we're bound to have a pullback, but people were calling on day eight, oh, it's market's going to pull back. Of 8 days in a row of green, meaning the market went up. Day nine, oh, we're going to have a pullback. We're going to have a pullback. Day 10. And so, really, what this is showing is that nobody can time the market. And so, those buffers, those investments that we're utilizing in our portfolios can help eliminate the guessing and do its job, whether the market goes down or up. Okay. So, market recap, it's going great. Market's going up. Oof. It's no longer an issue, but we just went last 2 weeks, the market going up. What's the next 2 weeks going to be like? And if you're fully exposed to that downside risk, or if you have individual stocks that have that volatility risk and you don't want to ride that risk anymore, that roller coaster, then changes need to be made. It's a easy conversation, but hard to grasp sometimes. That's why we're here to help people understand what does that change look like. So economically, and just geopolitically, why is the market going up? Because we see relief in the Iran conflict, the Strait of Hormuz. Sorry if I'm mispronouncing it. I don't think anyone will get offended, but it's open, or so they're saying, is opening up, and so we're seeing the cost of gas and oil drop down. Hopefully, it continues. If not, we'll see that ripple effect. Um, and so we're seeing some relief. We're seeing, this market want to push higher, and that is great. Doesn't mean we can't have pullbacks along the way. Now, economically, what we saw that a lot of people are not talking about is the 10-year treasury. The 10-year treasury, based on what I saw, went up to 4.45, 4.46-ish at the peak of this Iran turmoil. Um, so, there's a lot of opportunities there. And we discussed on an earlier video, when rates go up, there's opportunities, and when rates go down, there's opportunities. But since rates are, and the 10 year is still, floating up in that 4 to 5 range, there are some opportunities. And I will preface this. If you're CD shopping, you're yield shopping, don't. You know, there are some classic mistakes right now to locking in your money to a CD, or any type of yield producing fixed income mutual funds. And a lot of that has to do with taxes. There are things that can yield you much more under a better tax consequence, or maybe a tax deferred. And that's an educational piece that I'm not going to go into today. I have prior videos that we do talk about those things, but for those with non-qualified accounts, so taxable accounts like trusts, joint accounts, even your savings, anything yield producing is going to be taxable income. Um, and we're talking about portfolio efficiency. Yeah, there's much better options out there, and so please reach out if that's something you want to talk about. How do I not just get a great return, but keep that return? As most people with CDs are, they're going to be taxed on that yield. So there's ways to avoid that, or better investment options. So rates, yeah, rates are up. There's a lot of different ways we can get tax deferred rates, and that is very exciting to talk about. I could talk about that for an hour. I won't today. But ultimately, the market and the economy will always present opportunities. There's an opportunity right now. Sometimes we don't see those opportunities until we look back in time. But exploring that in your retirement portfolio should be consistent. So if you're not consistently looking at ways to be more efficient with your portfolio, with what the economy or what the market is providing, then you need to reconsider your retirement strategy, or your plan. Whether that be with another advisor, or maybe do it yourself, or your brother's son is helping you. It's very, very important to have a retirement plan. This means estate planning, tax planning, income planning, portfolio management. There's more pieces to the pie than people realize when retirement planning. So, talked about rates, talked about planning, the market, the economy. I want to make this quick, and I think I'm hitting all the parts here. Really kind of, Blair, I get asked, what do you see happening in the next couple weeks and months? Well, what do we know? We know it's a midterm year. Midterm years often bring volatility, and volatility can be double-sided, upside and downside. So what I do expect is that there's going to be big runs up and big run pullbacks back, and we're going to have volatility throughout this year. We shouldn't be afraid. We also shouldn't be too greedy, and we should just expect that roller coaster. And but in the upcoming weeks and months, we really need to see if this Iran situation concludes, because we keep hearing things, but the saying goes, trust but verify. I do think, it being the 250-year anniversary, Trump's going to have, I think, something at the White House. He probably wants the market at all-time highs. We're just speculating here, and this is not financial advice, but um, could I see some major pullbacks along the way and some volatility? Of course. Again, back to why we use the defined outcomes. That's why they call me Buffer Blair, because we buff out losses when they occur and we reap the upside. Um, One other reminder before I sign off here, long-term care. I made a super long video about this and gave some great information. I get nobody really wants to watch 40 some minutes or however long it was. But here's the problem, and I'm going to tell you the quick solution. If you're concerned about long-term care, right now there is a unique way of solving for that. The traditional way is having a policy that includes underwriting. Okay, underwriting, see if you're healthy, and sometimes if underwriting doesn't go well, they're going to do one or two things. They're going to jack your premiums way up, or they're going to simply just deny you of that policy or that care. Okay, so underwriting and then ongoing premiums. Well, you're paying these premiums. Even if you have great health, they're high premiums. And over time, you're just paying and paying, and you'd be lucky if you just get your money back if you ever utilize the policy. Um, and so, what if you don't need long-term care? Well, all those premiums were wasted. So what we're throwing out there is that there are specific solutions that don't have the underwriting, don't have the ongoing premium, and nobody's talking about this solution. That's what's throwing me for a loop here, and we're trying to make this known and educate those who are listening. So please contact us if you want to hear more about this. But it doesn't have those ongoing premiums. It is an investment first. It's something we invest into, just like we would invest into those buffers. And it has long-term care benefits attached to it that don't have any type of fee, ongoing premiums, or underwriting. So we just eliminated three huge problems: fees, underwriting, and ongoing premiums. Instead, we're going to have a structured investment that grows with the market, has downside protection. And guess what? If you need long term care, you have those benefits attached to it. If you do not need long term care, no worries. You have the investment that can give you cash value that you can give to your beneficiaries instead of cashing out premiums to these insurance companies and it being a waste of money and a wasted time. So that's a little reminder on long-term care. That was the 40-minute condensed into 2 minutes here. And lastly, I just hope everyone has a great weekend. If you are concerned about the planning, the marketing, the buffers, the long-term care, anything like that, please feel to reach out to us. We have information below. Tushausgroup.com. We're here in Scottsdale, Arizona, and in San Diego. We got a full team of estate tax planners and professionals. Even if it's just a simple question, reach out. Hope everyone has a great weekend, and we will see you next Friday.